The IRS just announced the official tax brackets for 2026, and here's what I found. If you earn a paycheck, you'll get to keep a little more of it next year. If you invest, more of your gains will be taxed at friendlier rates. And if you save for the future, you'll get more room to stash cash in retirement and health accounts, all with bigger tax breaks already built in. And that's because the IRS is raising the income threshold that defines each tax bracket. So more of what you earn stays in lower tax zones instead of creeping up into higher ones. I've gone line by line through the IRS documentation so you don't have to as a practicing accountant at keepmost.com. So let's walk through exactly what changed, what stayed the same, and how to use these numbers to reduce your tax bill going forward. But before we dive into the new tax brackets, it's important to clear up one of the most common misunderstandings about US taxes. When you hear, I'm in the 22% tax bracket, for example, that does not mean that all of your income is taxed at 22%. Instead, think of it like stairs. Each step represents a bracket, and only the income that lands on that step gets taxed at that rate. So if you earn $100,000, your first chunk of income is taxed at 10%, the next portion at 12%, and only the top part of it is taxed at 22%. You see, your average tax rate, also called your effective tax rate, ends up much lower. And for most middle income earners, that's around 13 to 15%, even if your highest bracket is 22%. So why does the IRS change brackets each year? Well, the IRS adjusts income thresholds to account for inflation. So you're not taxed more just because prices rose. It's called inflation indexing, and it keeps your tax rate in line with your real income power. So for 2026, the IRS applied an average inflation adjustment of about 2.7%. with a little extra boost, 4% for the 10% and 12% brackets, and around 2.3 for the highest ones, which basically means that people in lower and middle income ranges get slightly more relief. So how big is the difference? Let's look at the new numbers. So for 2026, the 7 tax rates remain the same: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. What's changed are the income ranges that fall into each one. So if you're single, your first $12,400 is taxed at 10%. Your next chunk, up to $50,000, is taxed at 12%. From there, 22%, 24%, 32%, 35%, and 37% tax kicks in as your income climbs. Now, married couples get double the benefits, starting with tax at 10% up to $24,800 and moving through the same tax brackets, just spaced further apart. And many people actually decide to get married after finding out that they can save more money within those brackets. And don't worry about memorizing these. What matters is the direction. Each line moved upward, and that's what quietly puts money back in your pockets. Now, let's talk about where the bracket jump hurts most, right? The moment where moving up a bracket can change your after-tax income the most. And in 2026, the biggest leap happens when you move from 12% to 22% and when you cross from 24% to 32%. Each jump represents roughly an 8 to 10% increase in what you owe on additional dollar above that line. So if you're self-employed or your home income varies, think bonuses, commissions, or business profits, those things matter. And shifting when you recognize income or when you make deductible contributions can keep you inside a lower bracket and protect thousands of dollars. For example, if you're projected to earn just above $211,000 as a married couple, maxing out your 401k contributions or timing a charitable donation could keep you in the 22% zone instead of bumping you into 24%. Now, that 2% inflation adjustment, it might not sound like much, but over time, these incremental increases compound. In 2025, the 22% tax bracket for single filers was capped around $103,350. This year, it stretches to about $105,700, which is roughly around $2,300 of additional breathing room before you climb to the next rate. For someone making around $100,000, that's a few $100s less in tax owed, and that's without any new deductions or credits. So when you multiply that across tens of millions of filers, and we're talking billions in collected savings nationwide, it's also a signal that inflation is cooling off and stabilizing, meaning smaller, steadier adjustments from here on out. And that's great news for anyone who wants to plan ahead accordingly. I ran the numbers for one of my clients, a teacher making around $90,000. And even without changing anything, she'll owe about $400 less next year. So you can start to understand how this can add up quickly. Now let's shift from rates to deductions, because the standard deduction is the single biggest tax reduction tool for most Americans. In 2026, here's what it looks like. $16,100 for single filers, $24,000 for head of household, and $32,200 for married couples filing jointly. That's about a 2.2% increase from 2025. And under the new tax law, those higher amounts are permanent. No more sunset clauses that hang over them. So what does this mean practically? Well, if you're married and in the 22% bracket, that roughly $2,200 increase in deduction could save you around $480 in taxes, purely from inflation indexing. No extra deductions, no tax tricks. And every year I get this question: should I still itemize my deductions or just take the standard deduction? And for most taxpayers, the standard deduction wins easily. Because it keeps rising, fewer and fewer people can stack up enough itemized deductions, like mortgage interest, charitable donations, or state and local taxes to beat it, unless you have major expenses that push your total deductions well above that new limit. Itemizing probably won't make sense for you in 2026. And this is actually a good thing. Simpler filing, faster returns, and fewer headaches come tax season. So how do these numbers stack up against last year's? You can look at a comparison chart right here. And while the pace of adjustment slowed, the outcome is still positive. Higher brackets, higher deductions, lower taxable income. That means if your income stayed roughly the same, you'll almost certainly owe less tax next spring. So let's run a simple example to see this in action. Say you're a single filer earning $90,000 in both 2025 and 2026. In 2025, your taxable income after the $15,900 standard deduction was about $74,100. In 2026, the higher deduction, which is $16,100, lowers that to $73,900. So now, because the brackets expanded slightly, you'll also have a bit more of your income taxed at 12% instead of 22%. And the result is roughly $350 to $500 less in total tax, just from these inflation adjustments, without changing a single thing about how you earn or spend. And once again, you multiply that out across a household or small business, and you're easily looking at 4 figures in savings. And most people stop here. They learn the new numbers and they simply move on. But the real opportunity is in how you use these tax brackets. So here's how to make the most of it in 2026. I want you to time your income and deductions. If you're close to a bracket jump, consider deferring income or accelerating deductible expenses like business purchases or retirement contribution. Next, consider maxing out tax deferred accounts. Every single dollar you put into a 401k, IRA, HSA lowers your taxable income today and may even drop you into a lower tax bracket. Next, you want to revisit your withholdings. With higher deductions, many people will end up over withholding. So adjust your W-4 so you're not giving the government an interest-free loan. So let's recap here. The IRS raised every income threshold about 2 to 4%, so more of your income is taxed at lower rates. The standard deduction is higher now across the board, and the average taxpayer will owe slightly less even without changing their behavior or their tax strategy at all. So these adjustments might look minor, but together they make a meaningful difference. And if you want to make sure every single dollar works harder under the new rules, visit keepmost.com. And we'll help you build out a custom plan to keep more, owe less, and plan smarter for 2026 and beyond. My name is Karan. I'll see you in the next video. Thank you for watching.